Good afternoon, everyone, and thank you for joining us today. On behalf of PL Wealth, I welcome a very special guest, Mr. Aashish Somaiya, CEO of White Oak Capital. Ashish is a very well respected leader in the Indian AMC industry with over 2 decades of experience across marquee institutions. He's best known for building high conviction portfolios and steering businesses with a very deep sense of purpose and long term focus. Many of us have followed his journey from his leadership days at Motilal Oswal AMC, where he scaled the equity AUM from just about 1,000 odd crores to 40,000 plus crores, and all while staying true to the philosophy of quality and growth. Before that, at ICICI Prudential AMC, where he played a key role across product strategy and distribution. Now, at the helm of White Oak Capital, Ashish leads one of India's most distinctive and research-driven asset managers. The firm is known for its bottom-up stock selection, process-driven philosophy, and focus on long-term wealth creation. But what makes Ashish truly stand out is his clarity of thought and ability to communicate complex market themes in very simple terms. I remember one of his quotes from an interview where he said that great investing is less about reacting and more about compounding. The goal is to be consistent and not clever. And that sums up the ethos he brings to the portfolio management role. We are truly delighted to have him with us and to share his views on the market, investment opportunities, and how investors should be thinking about their portfolios in the current environment. So, a very warm welcome to you, Ashish. It's a pleasure to have you with us. And on that note, I hand it over to you.
Thank you very much. Rajkumar, thank you very much to, entire Prabhudas Leelather, PL Capital, PL Wealth team, for organizing this webinar and, inviting me and giving me the opportunity, to speak to your team and your esteemed, investors. Thank you very much for, giving the opportunity. So what I understand is, first few minutes I'll just share whatever I can glean of the investment environment right now, and then of course, we will discuss. I'm sure you have, your clients' questions, and you may have certain points to raise. So we will take it up once I am done with sharing some of my initial thoughts. So. I think there was some. Can you hear me clearly? I think somebody's mentioned that the volume is low.
I can hear you clearly, Ashish.
Sure.
Maybe it's just a lag or net, some tech issue or something.
Okay, great. Yeah. No, I've also, I think the mic input, I've also raised the volume. And any which way, जैसे जैसे बात करेंगे volume बढ़ेगा. कम नहीं होगा. Yeah. So thank you very much for this. What I'll do, as I understand of the format, first few minutes I'll share whatever I have to share as far as markets are concerned. And then, I have a presentation where I would like to share some slides. And then, of course, we will take up any questions that you may have on behalf of all your investors. So, many years back, like, I'm a Guju, but I'm born and brought up in Mumbai. So I'll tell you, many years back, there was I met a stockbroker in Bombay Stock Exchange. And why I mentioned about Mumbai is because, it's well known that in Mumbai, the way people speak Hindi, the phrases, and some of the words are very peculiar to Mumbai. So I think this is about nearly 20 years back, not 20 years, yeah, 15 years back, like 2009, 10, 11. For many, many years, nothing pretty much happened in the market. Right? 2010, 11, 12, these were not great years. So I met a, very reputed broker at that point in time. And, as is the normal practice, in the market, when you meet somebody and you ask them, na, कि आपको क्या लगता है, बाजार क्या लगता है? That type of question people ask. So that person told me, very astute stock market participant, he told me, thaka dega. So that is very Mumbai style of saying that it's going to go nowhere. And why would a broker say thaka dega? Is basically, anybody who follows the market right now, and obviously you belong to a very, very blue-blooded, established, reputed multi-decadal broking company. So you can understand that, all of us, a lot of people, they land up 8:39 in the office, and, they're sitting in front of the screen the whole day. Now, if you look at the index, all of us put together, millions of people, we are all applying our force from multiple directions. The day starts and the day ends, and the market doesn't even move, a few hundred points. And few hundred point meaning I'm not even talking, even if you look at Nifty, Sensex nowadays moves in 1,000 point range, and Nifty moves in, sometimes 50 or 100 point range. So that is why I believe that, gentleman told me that market thaka dega tumko. Thaka dega meaning basically that, you are coming here every day and going back every evening. You feel that whole day you are in front of the screen, but you don't see much really happening. And in these kind of markets, what happens is that, we have been used to big moves, right? I mean, if you see 2020, then 2021, 2022, 2023, 24, 25, right? Till last year, we are all used to seeing big moves in the market. And when I say big moves in the market, what do we mean by big moves in the market, right? So let me show you a sample. I'm just putting up a slide here to explain to you what I mean by moves in the market and why I said that this year, people are coming and watching the screen, but you can barely see anything really playing out. So I'm just putting up a screen here. You can see this, right?
Yeah, we can.
Yeah. Now see, what did I mean by that? Now, if you see, this tells you Nifty 50 calendar year wise performance, correct? And this slide needs some explaining. The reason is, what it does is that 2000, every year, it has two data points for every year. The blue colored bar, it tells you what is the maximum drawdown. So it basically tells you that in any given year, from the highest point to the lowest point, what was the move in the market? At the worst point, how much was the market down from the highest point to the lowest point? So you will see that, okay, if you take 2020, for instance, the high point in 2020, I think Feb 2020 was 12,490 or something. And then by the time we came to March end, we were nearly 38% down. So from the highest point to the lowest point, index was 38% down in 2020, correct? But but the green part tells you what was the return in the year. The green part tells you that ultimately market closed up 16%. So what does this chart tell you? This chart basically tells you that in every year, where did the market go at its worst point, and finally where did it land up? So let's take a Lehman crisis 2008. At the worst point, index was down 59%, but then it didn't recover. The full year it closed also 51% down. And then take another year, like say 2012. These are the years, when market was flatlining. So it fell, went up. Like see, take 2012 for instance, 2013. At the worst point, index was down 14%, but then for the full year, it closed only 8% up. So you can say this is a small range. This also relatively small range. Like see, these are all small ranges, right? Like you can see all of these. This is a small range. So, what you will find is that practically every year, once the market has fallen double digit, and then it has actually, and see now what is happening here. Especially, especially you see 7 months of 2025 are gone. The worst point 8% down, and till now it is 8% up. Okay, so it's in a very narrow range. This is why I said in my opening statement that थका देगा meaning कि आप रोज आ रहे हो ऑफिस में, रोज आप स्क्रीन देख रहे हो, कुछ नहीं हो रहा है, अल्टीमेटली कुछ 10-20 पॉइंट ऊपर नीचे हो रहा है, राइट? So if you see, I have highlighted some of the range bound markets. Now this is actually very tight, right? I mean, see, if you look at index level, and yes, I should clarify, we use total return index, meaning that any such dividend which has come is added back. Okay. Sometimes people might remember optically the level of Nifty and say, नहीं नहीं 8% नहीं ये तो ज़्यादा गिरा था. That is because when you take price index versus total return index, of course the dividend is added back. So this is what I was trying to say, that we have been in a very, very tight range. But anyway, since we are on this chart, I just want to make a couple of points. First is that the market is like this, that in any given year, from the highest point, at least once, the market falls like double digits. See, 35, 39, 21, 16, 30, 13. I don't want to bore you by going line by line. In fact, single digit wala saal jo hai na, that is very rare. It's very rare. This year till now, thankfully, it is single digit. In fact, single digit rare hai. In fact, it is very, very normal, very, very usual for the market to fall double digit at least once in the year. And how many times it finally closes negative? One, two, either negative close हुआ three, four times. Okay, this is five. That's it. This is 25 years data. In 25 years, at least 21 or 22 times it has fallen double digit. And in 25 years, at least 20 times it has finally closed positive. So first of all, what I want to share for our listeners is that this is a ये circus है ये रोज का circus है मतलब it happens every year the market falls double digit and every year it finally recovers. Okay, this is one. At the same time, people also talk about the long story. So what is the long story? The long story is that India का जब से liberalization हुआ है ना, see lot of time people start stock market data from 1979 and all. There's nothing wrong with that. I always request people that don't look at 1979 and all. You start from 1992, 1993. There is a simple reason. Because before 92, 93, there was no, most of the sectors, there was no private sector, right? In most of the sectors, there was no foreign investment itself, right? We liberalized as a country from 1992. Our economic history actually changed after 1992, correct? So what is the long range? The long range shows that our nominal GDP growth is 12.4% compounded. Earnings of Sensex companies also 12.3% compounded. And the Sensex itself is 11.7 plus dividend yield. Matlab you can imagine easily that somewhere in the range of 13 to 14% is the Sensex compounding. So what it shows is that over 32 years, first of all, we are very lucky to be in a country where economic growth results in corporate profit growth. And corporate profit growth results into actual stock market appreciation. Some people might find it odd, huh? But there are not many countries in the world where it actually happens because in many countries, the economic growth doesn't result in corporate sector growth. It could be because of too much of it could be because of too much of structural issues. Like if there is everything which is owned by the government, right? Like China, for example, they have fabulous economic growth, but they don't have the same level of corporate earning growth and stock market growth because a lot of it is public sector. Corporates overspending on capital, poor return on equity. There are many structural issues. So first of all, we are blessed to be in a market where in the long range, economic growth results in corporate growth results in stock market growth because we have institutions, regulator, financial intermediaries, all of these things, right? Ministry of Corporate Affairs, SEBI, all of that fair and square we have. So we are lucky to be in a place where in the long term, economic growth results in corporate profit growth results in stock market appreciation. In the long term, we have delivered 13 to 14% compounded only on Sensex and dividends. We are not talking about PL Capital's portfolio or White Oak's portfolio or ICICI, HDFC, etc. We have not yet reached any PMS or mutual fund. Basically, we are lucky that we are in a market where economic growth results in corporate profit growth results in actual stock market appreciation, and in 32 years, it is 13 to 14% compounded. So there is a case for remaining invested for the long term. That is, this everybody knows. I don't want to bore you, but what people did not have noticed or what people probably did not know is this, that लंबे अरसे में 13-14% compounded है, लेकिन हर साल एक बार 13-14% क्या 20-20% गिरता है. So see, in a good year, you make in a good year, the index gives 13 to 14% return. That's the average. But it also says that in a normal year, which could very well be a good year because most of them are good years. So in a good year, you get 13-14% compounded. That's the average return of the market. But it also says that in a normal year, उतना गिरावट एक बार तो market आपको दे ही देता है. Which means that not only you should be invested in the long term, but you should also be willing to take opportunity or willing to take the opportunity whenever it presents itself. क्योंकि हमको these two charts, if you read closely and carefully together, then there is a very big message in it. लंबे अरसे में तो आपको अच्छा रिटर्न मिल रहा है, 14% compounded. But the beauty is that it comes with volatility. And that volatility is actually, क्योंकि अगर लंबे अरसे में 13-14% कंपाउंडेड मिल रहा है और आपको ऐसा पता चले कि भाई हर साल एक ऐसा विंडो आता है जहां पे ऊपर के लेवल से वैसे ही 15-20% डाउन है, तो इफ यू आर अस्ट्यूट इन्वेस्टर, इफ यू आर अ रेगुलर इन्वेस्टर, नॉट जस्ट मैं ये नहीं बोल रहा हूँ कि लमसम पैसा डालो और 20 साल के लिए भूल जाओ, उसमें तो पैसा बना है, वी नो दैट। मैं ये भी नहीं बोल रहा हूँ कि खाली एसआईपी करो। Basically, what I'm saying is that volatility, many years back, 15-20 years back, Rajkumar, very reputed brand, Surf, जो हमारे घर में साबुन होता है, Surf Excel. Surf used to advertise, दाग अच्छे हैं. Okay, because they're saying that how do you get dag on your clothes? Because you're having fun, you're enjoying. So, dag is a sign of kids enjoying themselves. So, volatility is good. In fact, I started my conversation saying, "Ye thaka dega," there is no volatility. Correct. So actually, volatility is good for people who want to make returns. But today we are in an environment where our domestic conditions are so strong. I mean, I wouldn't say so strong. Our domestic conditions are improving so well that it is preventing the market from having big downside. At the same time, the external environment is quite challenging, which is preventing the market from having a significant upside also. Right? See, if you take in the last 1 year, what has happened in the last 1 year? 1 year back, we were worried, 5.4% GDP growth. We were, election. This kind of environment was there, right? There was obviously that Israel and Iran has been going on. Ukraine and Russia has been going on. We had a scare that NDA will not come to power. We had a scare because of very poor corporate performance and very poor GDP growth. This is what we were struggling with 1 year back. Then if you see only 6 months back, rupee went to 89. US interest rates were rising, right? Rupee was 89 to a dollar, I'm saying. We were witnessing very sharp currency depreciation. We were witnessing outflows of FII, right? So if you take the first half of FY25, people were very concerned about India's prospects. Cut to the chase, you see now, we're in an environment where, I had this slide here. You can see 10-year bond in India, this was 6.3. 1 year back, it was 7%. And actually, in between, if you see, somewhere even higher, right? If you see US, for instance, we saw a period where there is not much decline. So the spread of India and US has come down. It actually tells you that as a sovereign, people are rating India very highly. How come the spread between India and US is actually shrinking? The common wisdom is that it should have been 2% or higher. Today we are sustaining, lower spreads because their yields are going up, our yields are actually going down. This month-end picture is not showing the clear thing. In between, they have even seen 5% kind of numbers, right? So what we are seeing is that if you take in India, interest rates coming down, liquidity going up, RBI cutting rates, willing to cut more rates, corporate performance compared to where it was 1 year back, there is improvement. If you take GDP growth itself, we started by saying 5.4%. We ended the year supposedly at 6.5%. And next year also forecasted 6.5%. More rate cuts to come from RBI. So the environment has changed significantly, and that is not allowing the market to fall too much. Correct. But on the other hand, if you see the external environment is such that geopolitical issues, whether it is Russia, Ukraine, the Western Asia. If you see, we had a scare India and Pakistan. We are still not calling it ceasefire. There is still this diplomatic row which is consistently on and on. So we are in an environment, and that gets reflected in this market movement also. And this gets reflected here that the domestic environment seems to be actually improving. The domestic environment is improving, but the external environment is kind of putting a lid on the prices. The beauty about the market, if you see today we are at 25,000 kind of Nifty. Even September last year, we were in 26,000 kind of Nifty. In between, we got this correction, from the highest point or whatever it is. But net now for nearly 10 months, market has been in a range, correct? Generally speaking, if you see that, okay, 10 months market has been in a range, the beauty about the market is that if it remains flat for a year, it automatically becomes 10 to 15% cheaper depending on the earning growth. So what is happening is that I'll use this segue to even share on the valuations, right? So if you see, this is what we use as our indicator. So what has happened is that while the market is range bound, it is slowly turning attractive. This is White Oak's price indicator or valuation indicator. Basically, what we use is adjusted price to book and we use yield ratio, correct? So if you see valuations as per our own frameworks, because the market is going nowhere, we are now at a situation where it is in the attractive valuation zone. And to top it all, interest rates coming down also results in some buoyancy for higher allocation into equity. So net, my sense is that market has been flat for a very long time. But the general nature of the market is to exhibit volatility. Today, we are in a confused kind of environment because domestic conditions are improving, valuations are becoming attractive, but the external environment is keeping a cap on the prices in the market. What do I mean by external environment? External environment, I mean three things. One is US economy is obviously expected to slow down. Second is there is collateral. I mean, there is cyclical reasons for US economy to slow down. But apart from that, this whole tariff related thing has also caused distress, right? Whether it is, and India is not their biggest problem. Their biggest problem is the trade deficit with European Union, which is said 250 to 300 billion. And their other big problem is with China, which is again in the range of 300 billion. So their biggest trade deficit is China and European Union. And there is obviously some, there also, if you can call it some, couple of steps being taken back, but no clear resolution, right? So US economy slowing down, this whole tariff related issue. And the third is the geopolitics, because nowhere in any part of the world, wherever the geopolitics was escalating, nowhere it has actually got a lid on it, or nowhere it is actually, some boundaries are being redrawn and stuff. And usually these things don't subside so easily, correct? So my sense is that while valuations are becoming attractive, the fact is that external environment is not allowing market to go up. When we say external environment, a lot is also discussed about FI, flow and stuff, correct? Now, I want to dispel certain notions out here because, and we can say with some amount of certainty on this because lesser known fact, White Oak itself is one of the largest FIs investing into India, right? So the thing is that we interact with global investors very, very closely. And what data I'm presenting here will actually dispel some notions, because generally there's a lot of fear mongering about FIs not wanting to invest, or exiting India and all those kinds of things. I think that is wrong. If you see this data, it will tell you how many times India is negative. See, 2025, this year, only 6 months have gone. We are in the seventh month. In 6 months, 4 months it is positive. First 2 months were negative. So FY25, I mean calendar year 25, let's just hold on. The year is not yet over. First 2 months were negative and then it became sharply, started becoming positive. But before that, you take till 2024. How many times is negative? One, two, three, four. First of all, India has seen negative flow only 4 times. And let me clarify, a lot of websites and a lot of places they are reporting only secondary market. That's not correct representation. Because secondary market में buying भी होता है, लेकिन selling खाली secondary market में होता है. लेकिन buying खाली secondary market में नहीं होता है, बहुत सारा buying primary market में भी होता है. So we are supposed to take the sum total. So if you actually look at this, FIs have been negative in India only 4 times. And these are most of the emerging markets are listed here. When negative hota hai, you see this is 500 million, 4 billion, 17 billion, 755 million. And see the positives, 29 billion, 24 billion, 19, 16, right? 14, 23, 21. Then you take 2024, most of the time positive. Then these 3-4 months negative, again positive. अभी हमारे से ज़्यादा see this, Taiwan. Thailand, South Korea, Philippines, Malaysia. I mean, Vietnam is probably the smallest market you can imagine. हमारे से negative ज़्यादा तो वियतनाम का है. So what we should keep in mind is that FIs have not been exiting India or selling India in any meaningful manner at all. We need to dispel those notions. In fact, we ourselves deal with many foreign investors. We are one of the largest FI managing $6 to $7 billion. And what we have seen is that there is one chart I need to show you. Basically, what has been happening is that bulk of the money which comes into India, a lot of that money would be non-dedicated active funds, which means, global emerging markets, global equity. Now, what happens is that, the issues with China after 2021, Russia, Taiwan, Turkey. So, in the last 3 to 4 years, emerging market as a basket has not done well. Within that, India has done fantastically well, right? So if you take in the long term, see this last 3 years, 5 years, 10, 15, 20. Most of our listeners will be surprised to know that in last 20 years, the best performing stock market globally in US dollar terms. So you will have some NRI clients and your clients will also have NRI relatives and all. They need to understand last 20 years, best performing stock market globally in US dollar terms is India. And the second is US. If you take China, for example, after giving 34% return in the last 1 year, the 5 year return is zero. And the long term return is also lower than India, right? So FIIs, what happens is that since bulk of the money comes as part of a basket like global emerging market, global equity. So if emerging market countries are not doing well, somebody removes $100 from an emerging market fund, तो लेना नहीं देना $15-20 हमारा भी निकल जाएगा. So if you have a beautiful house in a bad neighborhood, तो एक दो पत्थर तुम्हारा घर पे भी गिरेगा कभी कभी, right? That is the challenge here. Now, what is happening in the last 4 or 5 years? This thing is rising. See, this India dedicated block. Sovereign wealth funds are, sovereign wealth funds will have different country desks. So you can assume them to be exclusive India investor for that perspective. This block is now rising. This, which is 63, I can tell you a year back, this was 77. So there was a point in time when 77% of the money came to India indirectly. किसी बास्केट में पैसा डाला है, money lands up in India. वो बास्केट अच्छा नहीं किया, पैसा निकाल दिया तो इंडिया का भी पैसा गया. That was causing the problem. In the recent times, not only FII flow has been positive, the FII flow has been turning positive with a movement to invest in funds which are not basket but exclusively investing into India. So this is more sustainable long-term flow, which is choosing and deliberately coming into India. And this is set to rise. And the emerging market basket is going nowhere. If US economy performs the way it is performing and if the dollar depreciates, you will see a lot more money coming to us, not only directly to India, but also through the basket, right? So I think we have to dispel some notions about this whole FII flow thing. I don't think there is anything to get scared about. FIIs have been consistently investing in India and we have given the best returns to them. And we are one of the few markets where economic growth is translating into stock market growth and into corporate performance. Last thing I'll share, what should investors be doing given everything that I mentioned, local conditions, external environment, market is going nowhere, every year it gives double digit correction. See, today what happens is that because of external environment, it's not that we are very cheap. I said we are getting attractive, but we are not very cheap. अभी एक साल तक market move नहीं होगा तो obviously it will start getting attractive. But it's not like very cheap. And the external environment is not great. Any negative news, we are primed for a correction. But what did that chart show? This chart which I showed, what it shows, the chart clearly tells you that if there is a double digit correction or any correction, you should be willing to take advantage of it. क्योंकि लंबे अरसे में 13-14% कंपाउंडेड है, लेकिन किसी भी साल में जब डबल डिजिट गिरा ना तो आपको उसका फायदा लेना चाहिए. So, and the last thing I'll tell is that let's not, in the last 2-3 years, people have been overweight into small cap, overweight into, railway le lo, infra le lo, PSU, energy, defense. Now you see, Rajkumar, last 6 months, there's no trend in the market. Only stock picking is working. There's no growth value. There is no favorite sector. There is no PSU private. right? There's no value, quality. It's a stock pickers market. It's great for people like us. In fact, we struggle. कभी क्या होता है? We are doing stock picking. Stock picking नहीं चल रहा है. रेलवे, इंफ्रास्ट्रक्चर, एनर्जी. अगर आप रेलवे में टिक मार्क सब चलेगा. डिफेंस टिक मार्क सब चलेगा. That is difficult for stock pickers. When the market is heterogeneous, when there is no trend, then you see we get 4-5% compounded alpha. So this is great market for stock pickers. This is great market for people who are opportunistic. This is great market for people who can be, slightly contrarian in their thinking. I always tell people, Mr. Buffett said, be greedy when others are fearful. Be fearful when others are greedy. I always tell people, पहले सोचो others कौन है. The mantra for success is that you should not be in the others. Correct? So I think these are interesting times. Next 3 to 6 months, because of external environment, you will get some opportunity. The moment you get the opportunity, you have to be willing to latch on. But don't get into aggressive stuff like अच्छा अभी defense ले लो, railway ले लो, PSU ले लो. See, the market has become very heterogeneous. There are no more trends. So which means that you have to be in diversified, flexi cap, multi cap kind of portfolios. अभी हम लोग सब लोग PMS manage करते हैं. We run a diversified PMS. But in PMS, everybody wants some तड़कता भड़कता. People want अरे पूरा small cap ले लो, 10 stock ले लो, ये thematic ले लो, वो ले लो. That will work for 2-3 years. Fourth, fifth year, it will again go in the that railway siding kind of position. It'll just be on the sideline. So this is not a time to be adventurous. If the market falls, take advantage, but be with diversified, flexi cap, multi cap kind of portfolios. Whether it is mutual fund, PMS, AIF, it is somebody's choice. So I'll pause there. Just to just given a long background. Sorry for the monologue. I'll stop there. If you have any questions to take it forward, I'll be happy to cover that.
No, this is most insightful, Ashish. And some of these slides were very, very interesting to note, especially the drawdown ones, because people generally tend to focus on the calendar year returns, but people don't focus on what has been the drawdown. So this is extremely interesting. I have a few questions which has come to me, and maybe we'll start with that, and I'm sure there'll be some more questions which will come up in the chat as we progress. Um, with the US Fed still data dependent and global growth signs are still divergent, how do you see this impacting the fund flows into India? I mean, 6 months have gone, we saw the FI data. How do you see the next 6 months go?
See, I think any foreign investor, any global investor would just be, waiting for the dust to settle. Like, they say don't fish in troubled waters. So the trend is very clearly in favor of reallocation from countries like US into countries which are like even Europe and emerging market. So the trend would be in favor of exiting from US and getting into, and that is reflected in the depreciation of the dollar, right? And given what Mr. Trump is doing, given what is happening as far as the trade tariffs and all these things are concerned, and plus, I think there is definitely some political turbulence out there also. If not, then it's around the corner, right? So there would be a move from US towards Europe or more dominantly emerging markets. So one would be bullish on flows coming to India. But unfortunately, this, we should wait for the dust to settle, and this uncertainty has gone on for pretty much the entire 2025. But even with the dust not settling, I showed you the data. The flow has turned positive, and the move is for higher flows to come in actually. So one would be, and that is reflected not just in emerging market flows, etc. It can be seen in alternative asset classes also, right? So dollar depreciation, uncertainty in the US economy, all of those are good for flows coming to India.
So crude oil, commodity volatility, supply chain realignments continue to influence global inflation. How do you see these factors shaping your macro view on India?
No, see, look, right now, if you see India is counter-cyclical. You can clearly see that, we are cutting rates. We are seeing high liquidity. There is a push to prime the economy, not just monetary policy or even credit policy of RBI, and even the RBI is relaxing norms for lending, not only infusing liquidity and cutting rates, they are also making norms attractive for lending. So monetary policy, credit policy, on top of it, the government's policy to, bump up consumption and at the same time invest heavily into infrastructure and defense and multiple other. So the investment cycle is on, the government is pushing investment, pushing consumer with those tax rebates and the spends. So my sense is that there are tailwinds as far as our conditions are concerned. And you can see we are at record low numbers of inflation now, right? I mean, below 3% kind of number. And that's why people are assuming that there could potentially be another rate cut. And that may well be, if the currency is stable, there's no reason why we may not have more rate cuts.
Yeah, even the RBI governor had indicated very similar that a neutral view doesn't mean that we'll not cut rates. Um, given the rising geopolitical risks globally, tensions in Middle East, you mentioned the Russia-Ukraine conflict, the US-China dynamics, the trade, Trump tariff tantrum, if we may put it that way. How are you factoring these into your investment strategy or your portfolio strategy? What are you doing to mitigate these risks?
Yeah, so I'll just show you a sample, so Rajkumar, because, our way of investing, see, generally speaking, what we are very clear, I did give you a background of market valuation about the stock market behavior. And then, in between, I definitely alluded to macroeconomic conditions, in India as well as outside India. Now, those things I shared because, obviously our esteemed clients and listeners, they would want to know that, what are we reading or perceiving about the market conditions. And ultimately, whenever somebody is putting their boat into the river, they want to get their boat into the river with the least possible, when the water is relatively calm and the risk of turbulence is not so high. So, obviously we are just sharing these thoughts in order for people to be able to navigate. And we discuss about macros because macros are important. But there is one more thing I will say. Apart from saying that macros are important, the other thing is also that macros are not actually predictable. I mean, we never bet on the macros. See, when you invite me to speak about the market, I try to give my best assessment of what is there. But if you take our portfolio, let me assure you, the portfolio is not betting on macro views. The portfolio is actually, we run our portfolios to beat the benchmark, correct? We run our portfolios to beat the benchmark. And if you see the benchmark, there is something interesting I want to share with you here. See, I'll come to your question, but look at in terms of, because you mentioned that what actions we take in our portfolios. Now we are running our portfolios to beat the index. Okay. Now see the way the stock market behaves. If Rajkumar, if we did a poll of some people and asked them in 2024, at the even now, if you ask someone what was the best performing sector in 2024, they would have told you, what people would have told you? They would have told you energy, they would have told you infrastructure, they would have told you PSU Bank. In 2024, did anybody expect IT will be in the top performers or that pharma will be the leading sector? Answer is no. In fact, in 2024, people would have told you that IT is a contra bet and see now worst performer, correct? So basic point is, what? We discuss macros only to the effect that when we are putting our boat in the water, we are seeing whether water is relatively calm or not. But I am not going to, put my neck on the chopping block. In what sense? That every year the best performing sector rotates violently. Okay. Every year the style of which style will work, that also rotates very violently. Correct. Actually speaking, this year people thought that quality will start outperforming. But if you see the first 6 months, it is still value, right? Then you look at, there is another chart on market caps out here. Even the best performing market cap keeps on rotating. So what happens? We are managing money to beat the index. And what is the index? The index is not this or that. The index is large cap and it is small and mid cap also. The index is value also, index is growth also. Index is defensive and cyclical. So if you must be evaluating many fund managers, Rajkumar, you must have seen there are some people who invest only in small cap. There are some people who believe that their portfolio should be value style. There are some people whose portfolio is cyclical. There are some people who say that our current account deficit has become positive, so now we should buy domestic stocks. There are some people who say SOE is just a Firangi word for PSU. It's state-owned enterprise. It's basically public sector, right? So some people say PSU lene ka, some people say nahi lene ka. These kind of things. There are no binary calls to be taken. We are actually managing money to beat the index. And the index is not this or that. The index is this and that. So again, I'm repeating, we are discussing market to understand that when our boat has to enter, is the water turbulent or not? I think the water is not so turbulent now. If it gives a correction, you should enter. But I will be mindful that I cannot predict कौन सा सेक्टर चलेगा नहीं चलेगा और कौन सा ग्रोथ वैल्यू चलेगा नहीं चलेगा. So when we run our portfolios, what we do is this: when we run our portfolios, we ensure that our portfolio is balanced and the alpha is generated only from stock picking. We don't take any bets. So see what is interesting here. If you look at our portfolio, this is just take an example of FlexiCap, okay? Um, you take financials, see, index is 31, we are 32. Here we are 3% more, right? See what you can see, this only this we are underweight, right? This we are underweight. There are very few things which we are overweight or underweight. Our portfolio allocation in each of the sectors is pretty much comparable with the benchmark. If you take small and mid, okay, we are nearly 32% in small and mid cap, right? And benchmark is say, more like 28, 29% in small and mid cap. So large, mid and small close to the benchmark, sectors close to the benchmark, okay? But our portfolio is actually not benchmark. Our portfolio is 60% active. Now imagine that how we are managing. If your large, mid, small is in range, if the sectoral allocations are in range, somebody might think, boss, your portfolio is you're holding benchmark or what? But no, it is 60% different from benchmark, which means that at a stock specific level, see the large, mid, small, growth, value, defensive, cyclical, PSU, private, and sectors. Those things we are balancing because we don't want to take any bet that ये सेक्टर चलेगा वो नहीं चलेगा बिकॉज प्रीवियस स्लाइड में मैंने क्या बताया बॉस हर साल कोई भी अलग अलग सेक्टर चलता है यू कैन नॉट प्रेडिक्ट कौन सा सेक्टर चलेगा नहीं चलेगा. So what we do is that all the factors and sectors, this strategy is called a blended style. It's basically a factor diversified portfolio. So what happens is that we run portfolios which are balanced vis-a-vis the benchmark. But at a stock specific level, if you go and see this portfolio is 60% different from the benchmark. Okay, it is 60% different from benchmark, but it is aligned on factors and sectors. And if you go and see, now I'll just show you the performance actually. Just bear with me for a moment. If you actually see the performance, see this. You can see it is about 3% ahead of benchmark since last 3 years. Now, somebody might say 3% ahead of benchmark, 3% ahead of benchmark compounded since last 3 years. And it has beaten the benchmark on practically every time horizon, right? Now, why the portfolio is constructed this way? Why I didn't give you straight answer of which sector and how the macro is impacting. See, the macro is definitely impacting the portfolio construction. In which way? Macro is important, but macro is unpredictable. तो ये सेक्टर चलेगा वो स्टाइल चलेगा ऐसा सब फोरकास्ट करेंगे तो मार्केट अपने को सरप्राइज करेगा क्योंकि क्या चलेगा वो अपने को बोल के नहीं चलेगा. एवरी ईयर अ न्यू थिंग वर्क्स. So what we're doing, we are trying to generate consistent outperformance through stock selection and by deliberately ensuring that see who will take an example. ऐसा कौन करेगा कि यार BSE 500 जो भी है, मैं पूरा का पूरा वैल्यू लेगा, ग्रोथ नहीं लेगा. I will buy all the cyclicals and I will not buy defensives. I will buy overweight small cap, and I think large cap will not do anything. When you watch a cricket, you watch this IPL and all, we watch T20. Do you know every T20 match, every team, there are 5 to 6 batsmen, 2 to 3 all rounders, 3 to 4 bowlers, and wicketkeeper is always a good batsman. Why do they make the team like that? Because they make a team assuming that we may win or lose the toss. It may be Wankhede, but sometimes Wankhede behaves like Mohali. There may be due, there may not be due. Our opening batsman may succeed or it may fail. So cricket teams are made not by assuming we will win the toss. They are made by assuming we may win or we may lose the toss. The pitch may be batting friendly, but the pitch may turn. Right? So we also make our portfolios. We have a lot of views on macro and all, understanding of macro and all बराबर है. सब रोहित शर्मा को पिच समझ में आता है. रोहित शर्मा बहुत बार टॉस जीतता है, बहुत बार टॉस हारता है, लेकिन पिच उसको समझ में आता है. उसको सामने वाले का प्लेयर्स भी बराबर समझ में आता है. बट फिर भी वो टीम कैसा बनाता है? 5 से 6 बैट्समैन, 2 से 3 ऑलराउंडर, 3 से 4 बॉलर और विकेट कीपर अच्छा बैट्समैन होना चाहिए. वाई डू दे मेक क्रिकेट टीम्स लाइक दैट? बिकॉज we may have a view, but we don't have an accurate prediction of the pitch and the ground and the opposition's performance. So, same way, we make our portfolios to outperform under all or say most circumstances. We never go on the pitch assuming कि PSU चलेगा, प्राइवेट नहीं चलेगा, वैल्यू चलेगा, ग्रोथ नहीं चलेगा, रेलवे और इंफ्रा चलेगा, लेकिन FMCG नहीं चलेगा. We make the portfolio which is broad, blended, and well balanced. But at a stock picking level, we'll ensure it is 60%. तीन तीन ऑलराउंडर बराबर है बॉस, लेकिन रविंद्र जडेजा नहीं चलेगा ना, तो उसको निकाल के मैं किसी और को लेके आएगा. लेकिन तीन ऑलराउंडर चाहिए. सो सेम वे, स्टॉक पिकिंग वी मे बी वेरी डिफरेंट, but at a macro level we try to balance the portfolio and not get it. We don't want a situation where ऐसा टीम लेके जाएगा, टॉस हारा तो गेम हारा, खत्म. We don't want that situation.
Um, so how do you see the earnings growth trajectory for Indian companies, and, large, mid, small caps, given two reasons. One, obviously, the front loading of RBI rate action over the last 3, 4 months.
Yeah.
We don't know whether rate cuts will continue, but probably yes, given that some of the other global central banks are probably just beginning to ease now,
Yeah.
and they are under pressure to ease at a much faster rate. So how do you see this playing out for Indian companies, especially maybe your portfolio companies?
Sure. So, what is interesting is that if you see, if you take, say, for example, 31st March 2025, the quarter ended March 2025. What we got to see in that was actually that clearly small and mid caps towards the fag end. See what happens. Every result season starts with every result season starts with IT, and then couple of big banks and their deposit growth and their commentary and all. So what happens is that it started even last quarter started by saying we'll have some 6% earning growth or something. And that happens in April. And then, as the fag end of April and May and all, as it progressed, what we found was that in reality, the earnings growth was higher. And in fact, for, small and mid cap companies, it ended up being actually double digit. So, I already showed you even before you asked this question, our portfolio is fairly spread out. In fact, we have large cap. I showed you a flexi cap portfolio. You must have seen we are 24 to 25% in small cap. In fact, as we speak right now, we are raising a close-ended AIF which is investing only in macro cap and micro cap and small cap. Because what happens, Rajkumar, is that all the things people are talking, no, manufacturing, defense, electronics, the great ideas are in the small cap space. So we are actively evaluating. And when you mentioned about earnings, this is not this is not a slide which is made by me. Pardon me for this. I'm just showing you from the internet because this somebody friend of mine who I follow. See, you can see what it is showing. Last 3 years CAGR, small cap, large cap CAGR of earnings is 12%. Small cap CAGR of earnings is 19% compounded. If you take 5 years, large cap is 16 and small cap is 23%. And if you take forward projections, again, small cap is expected to grow faster than large cap. And if you take price earnings to growth, we don't follow price earnings to growth, but it's a simple ratio. You can see that small cap is attractively priced if you take on this particular dimension. So I would just say I'm not trying to make a case that people should get into small cap or mid cap. मैं पहले भी बोला that it should be a flexi cap portfolio. And alpha generation comes from small cap. So even in our flexi cap portfolio where there is no compulsion, we are 25% small cap. Not because we are top down taking a call कि small cap ही चलेगा. I'm just saying that the opportunities and the sheer breadth and the heterogeneity is in the small cap space. And one prerequisite for generating alpha, we have a research team of 34 people covering 1,000 companies. The alpha generation will come in a space where there is heterogeneity and there is maximum heterogeneity. Stock picking can be done where there is heterogeneity. Maximum heterogeneity is in the small cap space. Large cap में heterogeneity नहीं है. Large cap में क्या होएगा? You'll have big IT companies, big banks, HP, BP, IOC, all the steel companies. See, steel, copper, cement, oil, the big IT companies, the big PSU banks, they all move in tandem. अगर आपको बोला कि आपको अल्फा जनरेट करने का है लार्ज कैप में और आपको बोलेगा कि राजकुमार ऑयल में एचपी लेने का बीपी लेने का आईओसी लेने का क्या लेने से अल्फा जनरेट होएगा टाटा स्टील लेने का जेएसडब्ल्यू स्टील लेने का कि स्टील अथॉरिटी लेने का टीसीएस लेने का कि इन्फोसिस लेने का सी द हेट्रोजेनाइटी इज लेस द टैंडम मूवमेंट इज मोर it makes it difficult for a best of research team it becomes difficult to generate alpha but take small cap if I tell you that क्रॉम्पटन ग्रीव्स इलेक्ट्रिकल लेने का ओरिएंट इलेक्ट्रिक लेने का पॉलीकैब लेने का एस्ट्रल पॉली लेने का कि हैवेल्स लेने का जस्ट गिविंग एग्जांपल देयर इज वाइड हेट्रोजेनिटी शुड यू बाय एल्केम इप्का न्यूक्लियस यू नो और टेक एनी डोमेस्टिक फार्मा राइट अजंता फार्मा no correlation there is heterogeneity so when there is heterogeneity of business models and heterogeneity of universe we can add alpha that is why we are engaged in having very large research and actively investing in small cap.
Let me take a few questions which have come up in the chat box. So the first question is the RBI flagged a deceleration in non-IT services and subdued demand in manufacturing sales in Q4 FY25, even as capex and infra showed momentum. Is there a divergence between market sentiment and earnings reality building up?
See, I think that markets are forward looking. Correct. If you see, I myself said that first half of FY25, third quarter of FY25, fourth quarter of FY25, there were very gradual relative improvements, right? Clearly, the first half of FY 2025 financial year was very bad. And by the time we exited from March, there was an upgrade on GDP, there was an upgrade on corporate earnings, and RBI has flagged all this is correct, but then RBI has relaxed its liquidity, credit policy, rate policy, and the government has relaxed its fiscal policy. So markets will always be forward looking. Okay. And before this question even came up, I myself showed that long term chart, which shows that in the longer term, corporate economic performance, corporate performance, and stock market performance moves in synchronization. And even from COVID bottom till now, the prices and the EPS has moved in tandem. And I also showed you charts which showed that the valuations are actually starting to look attractive because now for nearly 1 year, the indices are in the same range. So it's not a screaming buy. And I myself said that if there is a correction, you should be willing to take opportunity of it. Because क्या होता है लंबे अरसे में 13-14% कंपाउंडेड आता है लेकिन हर साल मार्केट एक बार 14-15% ऐसे ही गिरता है. So that's the context in which one has to really look at it.
Understood. So the next question is, despite strong GDP and GVA prints, unemployment has been rising 5.6% overall, 6.9% urban. Does this labor market softening raise any caution signals in terms of urban consumption?
So, if you see, what we have to look at is the corporate performance, correct? We have to see corporate performance, we have to see corporate guidance, and we have to see the earnings growth and free cash flow of listed companies. I understand that labor is a not just a stock market issue, it is a larger socio-economic issue, right? You have to see it in that light. When we are evaluating the market performance, yes, we will see urban consumption versus rural consumption. If you see, for example, consumption, our portfolio on day-to-day consumption is actually underweight. We don't have the FMCGs and staples. It is partly related to the question which the gentleman or lady is asking in this. All our consumption overweights are in discretionary consumption. So more urban, expensive, high-end consumption. Not high-end, I mean in Indian context, restaurants and apparels and footwear is also high-end in that sense. So that will impact what type of consumer companies we are owning, where we are overweight and where we are underweight, or where we are present and where we are absent. So I agree that, and this is being reported that, there is a rise in educated young, labor unemployment. It's a socio-political and socio-economic issue. But if you look at the here and now, you will have to actually see the corporate earnings and the economic performance.
This is a very interesting question which has come up. What core lessons from your time at Motilal Oswal AMC have you applied in scaling White Oak Capital's business?
Sure. So, see, every fund house, whether it is, actually, most people probably don't know the longest I worked is neither Motilal Oswal or White Oak. Actually, I worked 13 years in ICICI. I mean, I joined as a trainee in 1999 when I was studying finance. I was a trainee in ICICI Mutual Fund. And for 13 years, I worked there. But that was my actually the longest stint that I got my grounding and exposed to the industry. But yes, whether it is ICICI or Motilal Oswal or White Oak, see, every institution will have its, ethos in terms of what is the investment team, what is the competency, what is the investment style, what is the capability. If you really ask me, when I was working in Motilal Oswal, our investment philosophy, we were always more growth seeking, and I would say portfolios were always invested into companies which were seeking higher than average growth and companies which were exhibiting a very high earning momentum, right? If you see, for example, the way I explained to you, while your question was more in predicting which sectors, etc. If you see, White Oak is a relatively more conservative manager. I'm saying in relative terms. I mean, equity as an asset class, we are out and out equity investors. So equity as an asset class, one cannot say is conservative. Equity is for aggressive or growth-seeking investors. But I'm saying on a relative basis. On a relative basis, White Oak's portfolios are more targeted at consistency rather than at maximizing the alpha, right? A strategy like, for example, ICICI, where I worked, and Motilal Oswal, both these organizations, in my humble learning of very long stints, like 13 years and 8 years, I have seen that their portfolios deviate significantly from the benchmark. One is ICICI, when I used to work there, very value seeking, contra, cyclical, सस्ता stocks खरीदो, भले उसका beta is high and volatility is high, buy cheap. Motilal Oswal, when I worked with the team, always very growth seeking. Now, when I showed you the index, over a period of time, a value philosophy has also outperformed benchmark in different periods, and a growth philosophy has also outperformed benchmark in different periods. But ultimately, what happens is when the macroeconomic environment changes in the benchmark, sometime value, sometime growth, different segments of the market works. And that's why if you see mutual funds or PMS, even the winners keep rotating. There's a certain point in time when XYZ fund house is top performer. Remains like that for 2 years, third and fourth year, some other guy comes up. Then another. Why do winners rotate? Because everybody has their portfolio tilts and biases and segments of the market that they favor. When the macros change, what will work, what will not work, that changes. So one fund house where I worked was very value seeking. The other one very growth seeking. But in the market, these things keep rotating, keep going in and out of fashion. If you see, even before this question came up, when you asked me about, which sectors and what is the macro impacting your portfolio, etc., I gave you the whole. If you see White Oak's portfolios, they are not aimed at growth or value. They are not aimed at maximizing alpha. They are aimed at a blended style, which means that growth and value both are part of the market. You run a balance. You try to generate alpha purely from stock picking and not by tilting yourself to one wind direction or another wind direction, right? So the difference is that in White Oak, the portfolios or the fund management style is aimed at optimizing the alpha and aimed at giving consistent outperformance. In a couple of previous organizations where I have worked, the strategy has been aimed at maximizing the alpha in any given point in time. But what I have witnessed is that when you try to maximize the alpha, if the market environment turns, it can also give you significantly negative alpha. At White Oak, what we want is consistency, not maximum. That is the key difference. So I think it's a relatively more uh, conservative strategy because it is aimed at consistency rather than at maximizing.
Mr. Vinod Asava has this question on what's your view on hybrids, REITs, InvIT versus debt instruments as interest rates are coming down? Will it be a good bet to create a 2-3% alpha by investing in hybrid REITs, InvITs versus debt?
See, it's a very good question. In fact, we are one of the largest institutional investors in REITs and InvITs. Like say for example, adding up all of what Mr. Vinod has asked, we run a multi-asset allocation fund. Nearly 8 to 9% of that portfolio is in REITs and InvITs because REITs and InvITs are a fantastic instrument because it can, in certain market conditions, it can give you equity-like return, definitely more return than fixed income. That's the track record. So we are very bullish on hybrid instruments. We are very bullish on REIT and InvIT. And he's absolutely right in pointing out, and he's right that yes, we can create 2 to 3% alpha over fixed income if we do all these things. We already do it. And yes, it's a fact that in debt there are two challenges. One challenge in debt is that the yields are going down, and second is the adversity of taxation, both.
Okay, there's another question on gold and silver. So, what's your view on gold and silver? Should somebody start sip in them in the current market scenario?
See, I have a slightly what I would say outlier or slightly aggressive view on this. Basically, I feel that look, uh, there are some people who are all out and out equity investor. They want highest return, and their heart beats for equity. तो अगर आप इक्विटी इन्वेस्टर है ना तो आप इक्विटी में रहो. But there is another category of investors which is people who don't want the who cannot मतलब अगर 100 का 70 हो गया ना तो रात को नींद नहीं आएगा. People who are conservative, they don't want downside, right? See, so if you don't want downside, then you should be a practitioner of good asset allocation. See, one is the people who have, boss, I am a equity investor. They'll always talk about India and, the growth story and Amrit Kal and, they want highest return and they'll be comparing, Rajkumar, this fund, that fund, and they'll be always having 10 ideas under their sleeves and also equity investor should be in equity. But there are enough number of people, like I said, I'm repeating, where 100 become 80, they will lose sleep. They cannot tolerate downside in the capital. Then they should be proper asset allocators. And if you are a proper asset allocator who wants to cut the volatility, you don't want 100 to become 60 or 70 or 80. Then, and if you are going, then gold is a great asset, gold, silver, great asset to cut the volatility of a equity portfolio and to do proper asset allocation and to cut the downside. But if you're going to have gold, then you better have 15-20% in the portfolio. A lot of people, they just feel good by having some five, and don't count your wife's jewelry, please. That is not counted in this. Lot of time what happens, people put some 5%, matlab their portfolio is 10 crores and they have some 10 lakh rupees in gold. And then when gold goes up, they feel happy. See, I have gold in the portfolio. That is not, 5% gold is not enough to cut the volatility of 50, 60 or 90% equity. So either you're an equity investor or you are an asset allocator. There's nothing in between. That is my view. You may be having 10, 20, 30 crore equity portfolio and you're holding 50 lakhs gold ETF. You will feel good if the 50 lakh becomes 60 lakh. You will feel satisfaction that you had gold when it went up 20, 30%. That's great. Good to feel nice. It's good for anecdotal conversation. It is doing nothing for your asset allocation. That 50, 60 lakh or 1 crore of gold is not going to cut the volatility of your 20 crore equity portfolio. So either you are out and out equity investor or you are true scientific asset allocator. If you have gold, it should be 15% or 20% or at least 10% of your portfolio. Owning gold just for sake of it, not going to help.
We've already exceeded our scheduled time, but in case if you have time for two more questions.
Sure, sure. Yeah, we can take maybe last two. Yeah, sure.
Yeah, so are you exploring any new themes such as green energy, digital India, manufacturing, etc. in your portfolio?
Yes, so see, one thing I already answered that because we want consistency of performance and we don't want our performance to go wild swings. So we don't overly bet on any theme. But yes, to do justice to the question, I understand where the person is coming from. Out of all the things, whatever circus we have seen in the last 3 years, कभी रेलवे चलता है, कभी इंफ्रास्ट्रक्चर, कभी डिफेंस, कभी स्मॉल कैप, कभी जैसे बताया ग्रीन एनर्जी. So, see, anything which has become faddish, anything which has become fashionable. So, out of all the fashions which have come in the last few years, I think broader umbrella of manufacturing is the only one which I find sustainable. And I even all these railway related, infra related, capex related, defense. See, they are all sub-segment of manufacturing. I do believe that in our economy, the contribution of manufacturing will go up. That is my opinion. So I think the only thing which is sustainable is that yes, and a lot of new ideation when we say we invest in small cap, अभी electronics है, defense है, तो ये सब manufacturing है, ancillary companies है, capex है, ये सब manufacturing में हम invest करते हैं. So if somebody says broad theme of manufacturing, I would be constructive. Yes, that is reflected in our portfolios. But if anybody says anything like which become buzzword, then you have to be careful. And see green energy or say defense. This is a very small, a tiny sliver of the market. It's not big portion of the market. थाली खाएगा तो जितना राइस खाने का उतना राइस खाने का ना. राइस का जगह में पिकल खाएगा, पिकल का जगह में राइस खाएगा तो अगले दिन तबीयत खराब हो जाएगा. सो पोर्टफोलियो शुड बी इन सिंक विद द ब्रॉडर मार्केट. हमारा मार्केट अभी भी 65 to 70% लार्ज कैप है. हमारा मार्केट अभी भी 65 to 70% बैंकिंग, कंज्यूमर, आईटी, मैन्युफैक्चरिंग, हेल्थ केयर यही सब है. हमारा मार्केट अभी तक 60-70% ग्रीन एनर्जी और डिफेंस नहीं हुआ और कभी होने भी नहीं वाला है. राइट. सो जो एक रिप्रेजेंटेटिव तरीके से इन्वेस्ट करना चाहिए. I would not make my portfolio heavily into any of these narrow segments of the market. So it is, we have exposure to energy, but energy we will have exposure to suppliers, not to power generation companies. So and like green energy bolega, solar वगैरह बोलेगा तो it has all already it's become a buzzword, right? So you have to be careful.
Probably the last question, Ashish. How do you view the role of quant or AI-based tools in active portfolio management?
See, people who are using only and only quantitative methods to invest, for them it's great. For us, it's only processing, research, and efficiency. So we are still using human judgment for portfolio construction. But definitely our teams are working on different use cases to improve the efficiency of consuming the research and processing the information. But we will not give up the human element. People who are out and out quant managers, for them definitely it can be a great tool, but for us it's only efficiency and productivity, not so much decision making.
I think there are no more questions in the chat box, and we've exceeded our time limit also. But Ashish, thank you so much for
Thank
taking time.
you.
This was most interesting chatting up with you, getting your views on the markets, and I'm sure there's a lot of takeaways for all of us. So thank you so much once
Thank
again
you.
on
Thank you.
behalf of.
I'll email you that presentation. You can,
Sure.
yeah, thank you. Thank you.
Thank you so much, Ashish. Thank you, everyone.
Very
Thank you
much.
for
All the
joining
best.
us.
Thank you.
Thank you so
Bye.
much.